Hi, everyone. This is Jason Barick of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I've known him for around 15 years. He's a former Wall Street bond trader. He puts out two paid investment newsletters, the Mining Stock Journal and the Short Sellers Journal. Dave Kranzler of Investment Research Dynamics. Thank you for joining me again.
Thanks for having me on again, Jason. I always enjoy doing your show.
And Dave, we're recording this interview on Tuesday, August 13th, 2024. The US dollar gold price, it's rallied again. It briefly hit 2,500 yesterday on Monday, August 12th, 2024. Today, it's down a little bit to $2,464. Silver is not rallying as much as gold. But first, before we talk about gold and silver demand in Asia and gold and silver companies with the Q2 earnings and juniors, I want to ask you about the macro situation here. Do you think that we're starting to see a lot of evidence that there's a lot of fragility in the U.S. banking system, and the banking system in the U.S. and maybe other countries is starting to break now?
I do. I mean, it's hard to tell with the big banks. Obviously, the regional banks have their issues. Um, but I think one of the signs that the bigger banks are running into liquidity issues. I mean, look at what Warren Buffett has done with his Bank of America position. I mean, he's sold millions of shares. He may be out by now for all we know, right? Because
Probably,
we
yeah.
only know what he was doing through the end of June. So, and he's obviously going to have access to the inside books at Bank of America. But the thing is, I mean, these banks, the big banks, the too big to fail banks, they've accumulated a lot of like assets that are going bad, leveraged loans that they underwrote during the private equity bubble, and that they couldn't syndicate, they couldn't completely syndicate. They do have exposure to commercial real estate, and we have no idea what kind of off balance sheet OTC derivatives exposure they have to commercial real estate. They have, almost all the big banks have pretty hefty exposure to credit card loans and auto loans. So, and I mean, there's no way, especially the less than prime quality credit card debt and auto debt that they're sitting on. There's no way it's not deteriorating quickly. And I mean, we know that subprime delinquency rate is above where it was in the great financial crisis now. So um, another piece of evidence that I think points to liquidity issues forming in the banking, among the big banks, is if you look at the runoff in the reverse repo facility. Now, there's a couple reasons why the Fed let it run off. I mean, but to begin with, the Fed didn't have to let it run off. It could, if it wanted to. So that the liquidity that, or the 2 trillion and change that accumulated at the peak in the reverse repo facility was kind of the excess liquidity sloshing around the financial system from when the Fed dumped four trillion into the banking system during the COVID thing, and it basically was a way to suck some of that liquidity out because the Fed knew inflation was getting completely out of control. Well, it's been letting that facility run off. I mean, it's down to just over 300 billion now. And it could have kept that money captive by just hiking the rate a little bit that it pays on the reverse repos. So I kind of look at the runoff in the reverse repo facility is kind of a de facto or proxy quantitative easing program. And I
And
think when that thing completely runs out, they may have to start printing money again, because I'm positive, and I can't necessarily prove it with hard evidence just because the bank accounting is so opaque now. But I'm positive there's liquidity issues developing in even amongst the big banks. We know the regionals have issues, but I mean, if you look at some of these banks, their stock prices haven't held up very well. Citigroup, I mean, they've bounced this week, but last week they started heading off a cliff. So yeah, I think there's for sure problems, cracks forming in the banking system
So let me
and
add to
among the big banks.
Oh, I agree. Let me add to some of your points there. So Bank of America, a lot of people forget because the shares didn't crash initially. What they've written down over $100 billion of losses on older U.S. Treasury bonds. They do have a commercial real estate portfolio that's questionable. I don't know if anyone knows the amounts, although most people would say it's a small percentage of their relative loan book. It's not 30 to 50% of total loan book like it is for a lot of regional banks. And then you're seeing a lot of issues here. Warren Buffett, I think, with the banking system, a lot of people forget this over the last like 3 or 4 years. He offloaded a lot of his other bank stocks too. So I think he totally liquidate his positions in Wells Fargo Bank and US Bancorp, and US Bancorp is known as like the business bank for commercial real estate and business loans. He liquidated both positions over the last couple of years already, right?
I believe that's correct with Wells Fargo. I mean, Wells Fargo has other issues besides deteriorating quality of its assets. But yeah, I think he's completely out of Wells Fargo. I forgot he had invested in U.S. Bank. So, and I haven't really paid attention to what he's been doing with that position.
I think he liquidated most of it. I'm not sure if he still has any, but he owned that for decades. I mean, that was one of his top holdings. He considered, because if you remember the narrative, Dave, really since the 2008 financial crisis up until the last like 12 to 18 months, the narrative was that small business loans and commercial real estate office space was way, quote unquote, safer. It would be repeated like ad nauseum everywhere all the time for many, many years.
Mm.
It was that like, oh, the businesses are going to keep paying their rent checks. Oh, the businesses are going to they're not going to all stop paying their rent checks at once. That was like the narrative after what happened during the 2008 financial crisis. But then it seems that we're back into similar games with the banks and accounting to what the extend and pretend games of 2005, 2006, and 2007. I would argue that a lot of these banks have enormous losses on their commercial real estate and their other consumer loans that they're hiding so far. They haven't marked to market yet.
Right. Oh, I agree with that. And, who the hell knows what's going on off balance sheet with their OTC derivatives exposure?
What type of derivatives are you talking about? Are you talking about commercial real estate, mortgage-backed securities, collateralized loan obligations? What types of derivatives?
Credit default swaps on all of the above. Residential mortgage, real estate trusts, commercial real estate trusts, you know, they've even got counterparty exposure risk to just basic plain vanilla interest rate swaps. So, yeah, and also asset-backed trusts. I mean, they make a fortune underwriting OTC derivatives on that stuff. The spreads are, and also the trading spreads are wide. So, I mean, it's just like a repeat of what happened ahead of the great financial crisis. They get greedy and they get way over their skis on their counterparty risk exposure. Even if they say, oh, well, we're hedged out, we've laid off a lot of the risk. Well, they've still got, the counterparty risk there from their hedging counterparties.
And those are other banks, or are those like hedge
Hedge
funds and
funds,
pension funds then?
banks, hedge funds, banks, insurance companies. Because if you remember back in 2008, AIG defaulted on a massive amount of subprime of OTC derivatives that were indexed to subprime mortgage trusts, I mean, if the U.S. government and the Fed just let the market solve the problem, Goldman would have gone out of business.
Oh, yeah, that's right. So wasn't AIG, they were the market maker for these credit default swaps, right? And they sold these things naked, unhedged. So they had all this exposure if the credit default swaps became in the money, but they were claiming for years that the housing prices never went down. So basically that it was free money.
Exactly.
And do you think then there's similar situation here that one of the entities, maybe it's Norinchukin Bank, the Japanese bank, the fifth largest Japanese bank that decided it wanted to be a big shot and be a market maker in collateralized loan obligations and commercial real estate, then maybe they did something like that over the last 10 or 15 years?
I mean, I haven't looked closely at that bank. I know that they're falling on the sword, but it's a pain in the butt to look at, you know, um, public financial filings from banks and to do so for a Japanese bank, I just don't have the time for that. But yeah, I mean, they're clearly, I'm assuming it was probably commercial real estate. I think I read that they were a big uh, financer of commercial real estate debt in this country.
Yeah, SoftBank too. We were discussing before we started recording that Wolf Richter has been putting out articles, and he lives in the Silicon Valley, San Francisco area for decades, saying that not only was SoftBank like floating Japanese junk bond yields to the Japanese retail investor to go and invest in unprofitable Silicon Valley unicorn tech stocks and Chinese tech companies that had no profits, they were also buying up all the office buildings for these tech companies, and so they could collect the enormous overpriced rent premiums.
Yeah, SoftBank's a mess. I mean, I mean, I wouldn't be surprised if the Bank of Japan is keeping SoftBank alive.
Or the Federal Reserve Bank. I mean, I literally interviewed hedge fund manager Nancy Davis around July 4th, and she has a bond volatility hedge fund. She told me that she reads all the press releases from the U.S. Treasury and the Federal Reserve Bank, and she was adamant that the Norinchukin Bank, that they got a separate like reverse repo or currency swap line, because she said that the Fed panicked that the bond losses were way larger than $10 billion that they've disclosed. And those losses were what, 3 times the amount that the market was expecting.
Yeah, that wouldn't surprise me if the Fed is provided liquidity.
Well, Janet Yellen did go to Japan. Excuse me, she went to Japan. I think like a week after she went to China. So people forget that that was February or March. So I suspect that she was warned, or she was discussing with the Bank of Japan people, that the Japanese banks were having a lot of problems back then, and that eventually in the coming quarters there would be problems with the commercial real estate and the derivatives, like you said. Also, it does look like, Dave, that there's problems with like the yen carry trade and the leverage short volatility trade, and the Japanese banks are one of the main lenders for the yen carry trade. So they've loaned out to all these American and European banks for the yen carry trade, and also to hedge funds.
Right. That's right.
So you think then the Fed is what, the lender, the chief bailer outer of last resort? Then they're going to probably have to step in and start issuing currency swap lines to the Bank of Japan if they're not already doing so.
I wouldn't be surprised if they're already doing so.
So, Dave, I want to switch now to commercial real estate and multifamily in the housing market, because I know you cover that. You just put out an article for free for our listeners. It's from your paid newsletter, the Short Sellers Journal. The housing market is crashing. Rate cuts won't help. Why do you think that the rate cuts won't fix the the residential real estate and commercial real estate markets?
Well, I mean, there's several variables that are affecting the housing market right now. Obviously, affordability is one of the biggest variables, but also, affordability has several components to it. I mean, yeah, housing prices have remained very high, even though they're starting to come down in a lot of cities. But the problem is that your average household that is renting or that would want to do a move up trade from an existing home, that the deterioration in their financials has been so great that they can't afford, first time buyers can't afford to buy a home, and potential move up buyers can't afford to move up. So, and you're seeing that in the housing numbers. I mean, with existing home sales and new home sales, almost all of when they report the monthly numbers, there's two price buckets that are showing small increases on a monthly and a year over year basis, and that would be well, not necessarily year over year, but monthly, and that would be the 750 to a million and over a million price buckets, because that wealth demographic, income and wealth demographic, can still afford to overpay for a house. But below that, you're seeing a decline in sales, and especially at the lower level price buckets. So there's affordability and interest rates. A cut in interest rates, yeah, it might make the monthly cost of servicing a mortgage lower, but it's certainly not going to help bring down the price of houses, right? An interest rate cut, and all of a sudden potential home sellers are going to be like, no, I'm not offering my house at a lower price than it would have been before the rate cut. So that's going to be an issue. Um, and I just think that in general, with price inflation, the cost beyond over and above servicing the mortgage, the cost of maintaining a home, with all the other expenses involved, it's just becoming unaffordable for people.
Oh, yeah, I agree.
I actually
Property
think we're gonna
taxes. Yeah, there's tons of
and
articles all over the place about a lot of states, local municipalities raising property taxes. And then the other big one that no one was anticipating are the insurance companies. They have bond losses, commercial real estate losses. They're jacking up premiums like crazy for homeowners insurance.
yeah, our homeowners insurance went up. I can't remember how much, but our property taxes went up 20% this year. So, it's an interest rate cut isn't going to make homes any more affordable than they are right now.
Unless it's in specific markets, Dave, like certain cities and metro areas in Texas or Florida, like Austin metro area in Texas or Dallas metro area, where I think they're overbuilding homes at around $1 million or more. So it seems like there's going to be an oversupply, and there's a lot of communities in Florida where I'm hearing very similar. So it seems that there's going to be like a oversupply in those markets soon.
It's not just the high end, and there's already an oversupply of homes in Florida. And one of the sources of the oversupply is Airbnb, and properties are starting to flood the market. But there's in general an oversupply of new homes, from finished new homes that aren't sold yet. There's a 13-month supply based on the latest new home sales report. There's a 13-month supply of new homes sitting on the market right now, and home builders
Is
don't
that
always.
nationwide or is that in like
Nationwide.
specific? Okay, so it's not
Nationwide.
like it's probably even worse than in certain areas of Texas and Florida.
Yep. It's probably worse in the Metro Denver area. I mean, I've got a good friend and colleague who he didn't want to buy a new home, but his wife insisted on it. He had been renting since 2018, and so we bought a home north of Denver in an area where DHI, DR Horton's been um, building a lot of new homes, and he said he's just can't believe how many finished homes are sitting on the market in his neighborhood, in his area, that are unsold. They've been on the market for a while, and DHI continues. They're still building. I mean, those homes are never going to clear the market unless they cut the price in half.
And the banks don't want to have the keys again. So we'll see what happens. I mean, it's not a situation yet where do you think it's a situation similar to what 2005, 6, 7, where we're going to see entire streets like in Las Vegas and Nevada area where they're empty and then like a hedge fund or a bank just ends up owning the whole thing, or BlackRock?
I mean, BlackRock, knock themselves out, then try and fill it with renters. So, I think what's coming at us in the housing market could end up being worse than 2008.
Well, the home builders ETF, I haven't looked at in the last couple weeks. I interviewed Melody Wright in the last month, and the last time I looked at it, it was at an all-time high. But the home builders are just basically subsidizing people's mortgages to sell the home. So they were buying like 200 basis points or more off of people's mortgages to make sure that they sold the new homes.
Right, rate buy downs. But the thing is, it's like, there's only a certain percentage of potential home buyers that can even afford a mortgage now, even with a rate subsidization from a home builder. And they're going to have to start cutting their prices if they want to clear inventory. They're going to have to start cutting prices to a point that's below their cost of construction. And I don't, I spend a lot of time analyzing the home builder financials, and I don't think we're that far from that point of no return. And so at some point, probably within the next 6 to 12 months, you're going to start to see home builders take big inventory write downs.
Do you think that this commercial real estate bubble that's really just starting? I mean, we're seeing every day in the headlines that a insurance company or a pension fund is liquidating an office building for all cash, way below the market price that they paid even a couple of years ago. Sometimes the discounts are over 80% what they paid only a couple of years ago. Do you think that this commercial real estate bubble is the worst one in a very long time and way worse than any problems in residential real estate?
don't know about worse than problems in residential real estate, just because the resi market is so much bigger than the commercial real estate market. But yeah, I mean, I this is you're probably looking at the worst commercial real estate crisis we've ever seen in this country.
I think it's the worst one since like prior to the October 1929 crash, because the Empire State Building and a lot of other skyscrapers back then were overbuilt and they were delayed being finished for many years. But that's like the closest one I could find that was nationwide all over the United States, because a lot of the other commercial real estate busts were more local or regionalized, like New York City or Texas. They were not nationwide since like the 1920s.
Yeah, but you've had, it's not just office buildings, it's strip malls and it's multifamily. So, and actually, even self-storage. I've got a short recommendation on public storage, PSA, and I own longer dated puts on PSA, and I look at their numbers every quarter, and even they're admitting that they're starting to see less interest in people who want to come and lease out their storage garages or whatever you want to call them.
And I also think that there's an enormous cash flow problem with all these office buildings, commercial real estate, and that the Fed rate cuts won't help, even if there's refinancing, because a lot of, for our listeners out there, almost all of the holders of these office buildings, they all use debt and mortgages. And basically, it's an Excel spreadsheet where they have like a percentage for the occupancy rate. They have the average rents per month that they can charge. And so they run the numbers on the cash flow that they have, and then like minus the property taxes and the insurance costs and some of the other employee fees, and then their take-home profits are that. Well, I think all the math is broken, Dave. Even if the interest rates get cut by the Fed, they're just not getting anywhere close to the cash flows that were projected, because the occupancy rates in these buildings are nowhere near what they were projecting.
Yeah, I agree, 100%.
So the cash flow problem, I mean, do you think then this is going to result in bailouts? Is a question of when and not if on bailouts?
I don't know if the public will have the stomach for bailouts. It's interesting. I don't know. I mean, because and then if the Fed starts bailing out the banks, they're going to have to print a lot more money. And I don't care what the CPI says. Inflation's still running much higher than what the CPI says it is. If they start printing money again like that, I mean, you'll see price inflation go into the teens.
Well, I
Maybe not
think
the way the government measures it with the CPI, but certainly a real inflation measurement index would show, if they start printing like that, it'll show mid-teens inflation rates.
but both presidential candidates seem to be pro-weak dollar and pro-inflation. I mean, they've basically made statements that they want to increase government spending. I mean, Trump, if he wants to bring jobs back to the United States, he would increase tariffs on foreign goods. And given his real estate background, he may think that he can rebuild some of these office buildings and either convert them or improve them. So that would also be what bailouts or money printing or some type of loan subsidization plan.
I don't even want to speculate on what it'll look like. I mean, the problem that it doesn't really matter which party is in office, or whether it's Trump or Harris that gets elected. Who's ever in that office, they're going to have to continue increasing government spending. I mean, we're at a point now where, I mean, in July, 25% of the spending budget was for just interest on the government debt. And they have to keep all these programs alive and funded, otherwise the system will collapse. I mean, if they wanted to like remove a big chunk of the problem, they should just cut defense spending drastically.
Things are headed in the opposite. Things are headed in the opposite direction, my friend. I don't know.
Exactly. I mean, at some point, I think the Fed is going to have to go Weimar with the printing press.
Have you seen any of the research reports coming out of the think tanks now here in the Washington, D.C. metro area? And these are a combination of like political experts, defense company lobbyists, and then PhD economists. They kind of joint work together on these bullshit research reports. And they're claiming that the U.S. is underinvested in military and defense spending to compete with Russia and China by trillions of dollars. So they just keep pumping out this research that for their Cold War 2.0 for Russia and China, the U.S. needs to increase defense spending by trillions more.
And the problem is the programs that they're spending the money on, like, oh, they have a lot of problems with the military equipment that's being produced, and there's delay. I mean, it's that.
It's worse than that. The money is literally in a lot. I mean, there's just stories anecdotally that the money is stolen. I mean, there was like a $80 million contract given out to an empty warehouse in like in the Loudoun County area, and within like they didn't even do any due diligence on the guy's warehouse, so he had like a dummy like a PO box set up, and it was a fake company, an empty warehouse. No one went in to check the equipment, and he got an $80 million contract. And within a week of him getting wired the money from this was years ago, from what I heard, he was like on a plane to Dubai or another non-extradition country.
I'm sure there's all kinds of corruption and money grabbing going on. I mean, the U.S. military industrial complex is as bureaucratic and corrupt as anything can get in any country.
Oh yeah, Pentagon accounting is some of the worst. Yeah, Pentagon accounting is as bad or worse than the Federal Reserve Bank accounting and audits.
Well, it's a relative basis. It's all bad.
Well, Dave, I think this crisis. So I think the major issue with this commercial real estate crisis versus the residential real estate crisis. So you had a lot of regular people on Main Street that were victims of like what mortgage-backed securities and subprime mortgages back then in the last residential real estate crisis prior to 2008. But this time it seems the bag holders for a lot of this bad commercial real estate debt is pension funds and insurance companies.
Oh, absolutely. 100%.
So, Dave, for this cycle, it seems that there's a lot of exposure from pension funds and insurance companies to a lot of the commercial real estate and the mortgage-backed securities for commercial real estate. Do you think that we're going to see something similar to an AIG with one of the insurance companies like a MetLife, which disclosed back in December? They tried to claim publicly that their commercial real estate exposure is small and contained. Do you think that we're going to see an insurance company have some issues similar to AIG in this cycle?
Oh, I think we'll probably have more than one insurance company that'll choke to death on their not just their commercial real estate exposure, but also private equity exposure and things like that. I mean, and the same thing with the pension funds, because the pension funds, in an effort to like try and make their profitability look, or their ability to service their beneficiaries, they loaded up on private equity investments during, in the last, let's just call it the last 10 years, during the private equity bubble. And it allowed them, they would be able to, because the public market value of a lot of these private companies kept going higher with the stock bubble, they were able to mark up their positions. But now, forget it. I mean, private equity's got issues, and a lot of this stuff is really, really illiquid. And then also, pension funds have big exposure to commercial real estate because it was a yield hog play. They needed to do anything they could to juice the rate of the interest they were earning on their fixed income investments when the Fed took rates to zero. So yeah, I mean, I just think that what we're going to see this time around, unless the Fed goes Weimar with the printing press, is going to be much worse than what we saw in 2008.
So you said this private equity exposure, is this the same thing as these private credit pools? Because I'm hearing that these loans are starting to default. And so a lot of these pension funds and university endowments like Harvard Endowment and others, like they had enormous allocations to private credit pools. Are those the same as private equity or are they different?
It's different because what it is it's low grade. It's basically low grade junk bonds.
Okay, so there's collateral there, so it's not quite as
it's structured in all kinds of different forms. It's just smaller deals and riskier. I mean, yeah, and when everything's rosy in the economy and the Fed's printing money, yeah, it's great. You earn a higher rate of return than you will on treasuries, but now that I mean, obviously the economy is not anywhere close to as robust as the Fed is telling us it is, and interest rates got jacked higher. A lot of this stuff is struggling.
Yeah, there's no cash flow. So the counterparties that the loans were given out to are not paying off the loans, so they're in default. It sounds like, and the lenders
they're planning on refinancing them, and that window is closed right now.
So it's just the investment strategy for the lenders is to hope and pray that the Fed cuts rates enough to where the counterparties that were paying the loans can refinance and start to pay off the loans again.
Yeah, but all you're doing is kicking that can down the road, because a lot of these companies that have issued this that were financed with private market credit, um, you know, they're probably not going to be around in the next 5 years.
Are these private credit loans, are they very similar to collateralized loan obligations? Because the that collateral for the collateralized loan obligations for our listeners, it's below junk bond grade. And so it was called covenant light, but it really means that the collateral was so bad or non-existent at all.
It's a little bit different because it's not necessarily structured finance, right? I mean, it's just crap debt.
I want to transition now to gold and silver demand in Asia, especially from retail investors. The retail investor in a lot of other countries has been buying the short-term U.S. Treasuries, but a lot of the non-G7 central banks are not buyers of U.S. Treasuries. Do you think that we're seeing like a supply and demand issue become evident now in the U.S. Treasury market? It's a very serious one.
Yeah, absolutely. I mean, again, your part of your evidence of that is the rapid drawdown in the reverse repo facility. I mean, a lot of that money came from money market funds, and they're the ones who have been funding the treasury debt issuance. And that's part of the reason why most of the issuance has been coming at the short end, because money market funds have duration restrictions. So it, the government would be issuing much longer term debt if there was global demand for it, and I just don't think there is.
Yeah, I mean, also to add to your points there, you're seeing the central banks from Bank of Japan to defend their currency. What they've spent way over $100 billion of U.S. Treasuries just in the last 3 or 4 months trying to defend their currency exchange rate. They probably tap currency swap lines, and then even China in the last 6 months, I think they had a record amount of U.S. Treasury sales as well.
Yeah, they've been reducing. They're trying to reduce their exposure to U.S. Treasuries without question. And I think you'll probably start to see a lot more of that just from the BRICS consortium and the OPEC countries over in the Middle East. Part of it is, you know, geopolitical.
Oh yeah, post Russia sanctions, really the amount of, I would call it dollar cost averaging from non G7 central banks, just monthly buying of small amounts of gold tonnage, it's increased enormously since the Russia sanctions in 2022.
Exactly.
And what that in the past, those trade surpluses, those foreign exchange reserves, those used to be recycled into U.S. Treasuries, and they're no longer being recycled into U.S. Treasuries. They're going into gold tonnage instead.
Right. That's right.
Yeah, so the demand lately for treasuries, it's been from retail investors trying to pick up some yield, or like here in the United States, SEC accredited investors, but there's been a lot of foreigners in other countries that are looking at 4.5 or almost 5% for short-term US treasuries that have been buying treasuries, but that demand may start to drop if the Fed starts to rapidly cut rates.
Exactly. That's another thing the Fed has to think about before it cuts, unless it's already planning to start printing money again once the reverse repo facility drains.
Well, it looks like the Fed doesn't have any good options, but if the money supply is going to increase, does that mean that the commercial banks in the US are going to be the main buyers of treasuries until the Fed announces that they're expanding the balance sheet again?
I mean, it's a good question. I don't know. I just know that the money market funds have been the primary ones funding treasury issuance over the last 9 months to year.
Well, I mean, if the banks in the commercial banking system are not going to make normal loans into the real economy for real estate or other stuff, and it shows that their money supply is growing, they're probably loaning to the US Treasury then. They're creating currency out of thin air and then loaning it to the U.S. Treasury. So they're doing what the Federal Reserve Bank and the Treasury label it as an asset swap, but they're creating currency out of thin air and buying treasuries with the new currency.
Yeah. Well, M2's been rising since October 2023.
Well, that sounds like debt monetization, but the Fed's not counting it on its balance sheet.
Well, they're still doing their monthly quantitative tightening, but it's I mean, we have the easiest financial conditions since just before the Fed started hiking rates. So, the Fed has definitely fostered very easy uh, financial conditions, and it's again via the drawdown of the reverse repo facility. It's kind of de facto quantitative easing, in my opinion, because that money ends up in the financial system.
Yeah, I agree. I think the commercial banks are doing it right now, and the Feds, we need a Fed audit. We need to go see some of the toxic garbage the Fed has been buying if they've been bailing out Wells
That'll
Fargo
never
for.
happen.
Yeah, I know. There's like people that think that the Fed's going to get ended. Look, there's too many people here in Congress from both political parties who like what the Fed does. That's the
The
sad
Fed's
truth.
not the Fed's not going to get ended. I mean, what is the Fed? The Fed is the big banks.
And they're also they bail out large corporations. They fund the government here. I mean, if you're in Congress, you come into Congress and you're barely worth any money. Your net worth is low, and you have a ton of student loan debt. You play ball with the lobbyists and large corporations, the special interest groups. You do some side deals. 5 or 10 years from now, you're worth $10 million.
Yeah.
Keep your mouth shut.
Yep. That's exactly right.
And then if you're Nancy Pelosi, you could be a billionaire. You could be a big shot hedge fund trader. Are you surprised that gold and silver demand for retail investors in China, India, Japan, Korea, Thailand, Vietnam, are you surprised that the amount of retail investor demand for physical gold and silver has increased so much since October?
I mean, no. I mean, China's been actively encouraging its populace to buy physical gold and silver, and obviously India just cut the import duty, and that, I mean, you immediately saw premiums, ex duty import premiums go positive to the positive side when that happened. Because usually, and that was in July, usually, as you know, July and most of August is very slow seasonally in India, and there's not a lot of demand until the festival season kicks into full gear, and also until the farmers are able to harvest their crops and sell them. Because what the farmers do is everything they don't need to pay off their what it costs them to plant and harvest and to live off of on a daily basis. The rest of their money goes into gold.
Or
So,
silver. I mean, there's been increasing amount of silver.
right.
One of my friends in my MBA program here around I was in MBA classes for a while. He was Indian and he got married and he said like a lot of the dowry, it was a mix of gold and silver. It's like 50-50. So that's like the new trend is that a lot of the marriage dowries are like 50% gold, 50% silver.
Right. And that part of the reason for that is because the price of gold is so high relative to the price of silver. So, and yeah, the retail demand is massive in the East, but I mean, obviously the central bank demand's even more massive, and that's showing no signs of letting up.
Well, but I would argue the marginal buyer that's caused the price increase because normally in these macro conditions, Dave, with the dollar, I mean, there'd be a lot of paper price smashes in the gold market, but there was just so much extra demand for retail demand. It wasn't at one point the Shanghai gold price, Shanghai Gold Exchange, the silver price was $6 an ounce higher in Shanghai than it was here in the US. So, like for a bullion banker, that was like easy arbitrage. I mean, I don't think I've ever seen where the price differential was $6 an ounce higher for physical metal in Shanghai for online bullion dealers versus US. I think that was the case in October, November of last year.
Yeah, absolutely. But also don't forget, and a lot of people aren't aware of this, both China and India have massive national solar grid installation programs going into place. I just saw an article, I don't know, probably within the last month or 6 weeks, that China was released an update on their solar program, and they said they think they'll have it finished by 2030. So you're going to have 6 more years of just heavy demand for silver from the Chinese government for their solar program, and the same thing is going on in India.
That's an excellent point. Also, to add to your point there, I think in the last 2 months, they just brought online the world's largest solar farm in China near the Gobi Desert. So those solar panels don't last very long. They're gonna have to keep replacing those.
Right, and actually, so I was chatting with Silvercorp a few months ago, and they produce 7 million. They're going to produce 7 million ounces of silver this year. Their mines are in China, and they said they can sell every ounce they produce to Chinese customers. They don't have to export any of it.
Wow.
Sell it. Yeah.
And they're bringing on, didn't they bring on a new mine in Canada or Silvertip? I think Coeur d'Alene sold them a mine. Maybe it changed
No,
hands
they
again.
just acquired. They just closed a deal to acquire a copper gold polymetallic VMS mine down in Ecuador. I was actually chatting with the company about that today.
Oh
So,
yeah, Ecuador is where a lot of investor now that Lundin Gold has had so much success with Fruta del Norte, there's a ton of investment dollars going into mining in Ecuador.
oh yeah, this project this is going to be a great deal for them because even after net of the stream that they had because Wheaton put in the financing for this mine before Silvercorp got involved. And there's streams on the gold and silver that's produced. And then they've also got a 25%. There's a local company that has 25% of the, I think it's 25%. I can't remember. Maybe it's 15%. That ownership of the mine. But even after that, it's going to produce a 38% um, rate of return for them, IRR. I mean, it's a fantastic project.
Do you think that we're at a gold price if we stay at these levels and don't crash and we touched 2500 yesterday like I said at the beginning in the intro, do you think we're at a price where a lot of these potential new miners, the juniors that you cover in your newsletter, can they go out and raise say a couple $100 million and start to build a mine, or you think we're not there yet?
Oh, I think once permits are in place, and it's you've got a bankable feasibility study. I think any junior can raise financing, whether it's project financing from the banks that traditionally lend to mine construction projects, or companies like Wheaton Precious Metals or Orion Finance. I mean, there's a handful of non-bank pools of capital that'll finance mine construction. I mean, really the risk is in a for a project development company, the risk is really, aside from the obvious, metallurgy and all that other stuff, engineering risk is getting your environmental permits. But once you got that, and if you got a bankable feasibility study, you can raise money.
It seems for capital raising that a lot of juniors are raising funds now for drill programs. So like 10 million, 15, 20, $25 million for a drill program. I saw Franco Nevada start to issue smaller deals for a 20 million, 25 million, pick up a royalty in exchange for a junior to do a drill program. But a lot of the producing miners, so the mid-tier gold miners, they've been reinvesting their free cash flow now into large exploration drill programs. Do you think we're going to start to see more mergers and acquisitions from these mid-tier gold miners? They're going to be more aggressive.
Well, I mean, look at the deal that was announced yesterday. I mean, Goldfields pays 2.1 billion for Osisko Mining cash, and that was just because they had a 50-50 joint venture on the Windfall project up in Quebec, and so they paid 2.1 billion just to consolidate the 50% that Osisko Mining owned. So I mean, that to me that sends a real message to the market because Goldfields I think is one of the best managed gold mining companies out there, and they're basically telling the market, hey man, these larger junior companies with projects that are on the cusp of being converted into mines, or the smaller mid cap producing companies are dirt cheap right now. I mean, and there's deals going on. I mean, look at what Integra just did. Integra Resources. They just bought a Florida Canyon mine, and I don't remember what the deal price was, but they think, and these numbers aren't official because they got to wait until the deal closes and the keys are handed over to them. But they think that it'll be able to produce 30,000 ounces of gold between when they close and and next in the end of next year. So and then look at Heliostar. I mean they bought the rest of the Mexican assets that Florida Canyon Gold was sitting on for $5 million. And that, it's a cash deal, but and again, they need to get in there and do some reworking of the numbers, but it's got two small producing mines that I think they think it'll produce 20 to 30,000 ounces in the first year, and then 30 to 40,000 ounces after that. And they can use the free cash flow from that to fund the conversion of their Ana Paula mine and Ana Paula project into a mine. I mean, they'll need project financing for that, but it'll take them up to a feasibility, beyond the feasibility up to a construction decision. And I think the same thing holds true with Integra, which means not only are they getting a nice cash flow stream from these small deals for a song, it also means they're not going to be issuing shares until they have to go into the construction financing phase.
So it looks like there's a lot of conversions of these 50-50 joint venture deals, because isn't Goldfields and Osisko mining the Windfall project, isn't that already under construction? So Goldfields then thought that a lot of the major risks were de-risked since the mine is already under construction.
Is it under construction?
Yeah, I thought they did the feasibility study, if I remember correctly, in like 2022, and I think they already started it under construction. I don't know how far along. I haven't looked.
Well, here's the other thing. Osisko Mining has a 50-50 joint venture with Bonterra Resources on Bonterra Resources assets, and that includes a couple deposits plus property, and Bonterra's projects are adjacent to Windfall. In fact, they stopped the advancement of one of their projects so that there could be a power line that is it's going to run through their property or adjacent to their property to the I think it comes from a hydroelectric plant right to the Windfall mine, and they're leasing out their mine camp to the company that's doing the construction on it. And so at some point, Goldfields is just going to swallow Bonterra. That's why Bonterra was up 42% yesterday.
Yeah, I'm actually very familiar with Bonterra because they actually, I think in 2008 to like 2013 or 14, before the gold price crashed down to like 1100 briefly, they were actually mining there. Sandstorm Gold had a large gold stream. They helped finance that mine. There's a mill there too, and they have permits. There's already a mill there, but it's temporarily shut down. It's on like care and maintenance, but they have the permits to rapidly expand the mill. The junior just didn't have the cash, but now with Goldfields there, Bonterra has all the land surrounding Windfall. So basically there's like multiple satellite deposits and there's another mill. So Goldfields then has the potential to turn that into a district over the next, I don't know, 5 to 7 years, depending upon how quickly they want to build it and scale it up. But some of those deposits, though, Dave, I would say some of those deposits are like fairly marginal. But if the gold price is going to stay around 2,400, 2,500, I mean, the marginal deposits will be economic at these levels.
Yeah. So anyway, as I was saying, I mean, Bonterra has, they've got 8 gram per ton resource underground, and the resource is small on the what the heck do they call it?
They have the Barick deposit, but they also have the Gladiator. The Gladiator deposit's the open pit
portion of the Barick is high grade. So, and it's small, but it doesn't mean it can't be bigger.
The Gladiator deposit, which is also, I think if Goldfields wants, they can build like a district there over the next 5 to 7 years, depending upon the gold price and how quickly they want to invest there. But there's like 4 or 5 deposits around there. A few of them are lower grade open pit, but at 2,500 gold, the project economics might make sense.
Yeah, no question about it. I mean, I've been following Bonterra probably and recommending it probably since 2017 or 2018.
Oh yeah, they have good assets, but there was no financing available for so many years. I mean, Sandstorm restructured the gold stream because they brought that first mine with the gold stream. They gave them the financing to bring it into production. It got restructured into a royalty. Sandstorm Gold owns royalties on all their land. So Sandstorm doesn't have royalties on the Windfall mine, but they own royalties on all the land surrounding the Windfall mine.
Yeah, I think I knew that. I mean, I don't pay that much attention to the Sandstorm thing because I just always assume that Bonterra eventually would be acquired.
Oh
Whether
yeah, I
whether
agree.
whether it was a Cisco mining or there was even a possibility that Agnico Eagle because they're very active in that area.
Well, there's been rumors for 6 to 12 months that Agnico Eagle was going to come in and try to buy like at least the 40% stake in the Greenstone mine, which is a much longer life mine and lower cost than a lot of the surrounding areas for Bonterra, but they didn't. So far, Equinox Gold went in there and leveraged up their balance sheet even more. We'll see if they can bring the Greenstone mine on time and on budget. The full nameplate production capacity is supposed to come in the next couple quarters.
Awesome.
Well, that's like I'm not sure if you're familiar with that mine, but that one's like going to be the largest, highest grade and lowest cost open pit mine in Canada, other than the ones that are already producing. So that one's like sub 1,000 cost, and it could run for at least 14 or 15 years so far.
Wow.
Now, I want to ask you about Barrick Gold. So the CEO of Barrick Gold, I don't know, it sounds like a 180 because they were talking about buying copper mines when you were at the Denver Gold Forum last year. They said the CEO just made some comments that they want to go buy a large gold and copper deposit in Canada. Do you have any idea which potential juniors that they could be targeting?
um, I mean, I don't think Skeena's mine will produce copper, but it's going to produce gold and silver, and they in construction now. Yeah, I think they're in construction.
Is that a lot of reserves? Is that like a 10 million ounce plus reserve deposit?
Off the top of my head, I don't remember. I spent a fair amount of time on the phone with the company about I don't know, probably about 5 or 6 months ago, and I put a recommendation on it in my newsletter, and it's let me see where it closed. I started recommending it when it was in the low fours, and now it closed today at 727. Um, the other one that maybe they could have their sights on is Artemis Gold. That's a copper gold. That's a copper gold. That will be a copper gold mine, and that was a mine that they bought from New Gold, or a mine project that they bought from New Gold, and that's in construction now. So maybe they're, who knows? Maybe they'd be looking at that. I mean, beyond that, um, I mean, there's probably a lot of viable projects in British Columbia, but I kind of stopped putting resources into the British Columbian uh, projects for the most part because, especially the ones that are early stage, because they take forever to advance.
Is that because there's like no infrastructure that those mines are like out in the middle of nowhere and it requires what billions of dollars of infrastructure, power lines, roads, all that to get the mine under construction?
That's part of it. It's also expensive to drill because a lot of those projects are sitting on top of extremely hard rock. And so it's more expensive to drill that stuff. And a lot of them are. Oh, another one that they might have their sights on is Brixton Metals has a huge copper gold project up there, and which there's one of the large. I think it might be Rio. I think Rio might have taken a big stake in it, but they've sold off a 20% stake in that project. I can't remember if it's Rio or one of the other ones. I'm pretty sure it's Rio. But that could be another one. I mean, just because, a large international company has a 20% stake in it, that doesn't mean that, and Barrick, might not want to offer more for it. I mean, this thing could be, it's called the Thorn Project. This thing just could be a massive copper gold system.
Well, I mean, the larger ones like Newmont Mining and Barrick Gold, they're down for splitting projects now, 60-40 or 50-50. Look at the Cortez complex and some of the other projects. So they'll split, if the project's large enough, they'll split the capital expenditure cost to build it and share it 50-50 in a joint venture.
Yeah, I'm sure. And one thing you got to keep in mind with Barrick, unless they change their mind, they're not really necessarily interested in it's BHP is the company that has a just under 20% interest in the Thorn project. Um, but unless they're changing their tune, they've made it clear that they're not interested in paying big premiums when they do M&A deals. So, and that we may be in a different world now where if they want to acquire resources and reserves, that they may have to start paying premiums.
Do you think any of the larger companies or mid tiers could look in going and buying like the assets for Victoria Gold's heap leach project out of bankruptcy? Because some of the comments from the Yukon government seems like they're going to block future permitting for a lot of open pit heap leaching copper and gold mines going forward now.
It's not clear to me that Victoria Gold Mine will. It's not clear to me that that mine will ever operate again. I don't know. I mean, yeah, I was just talking to a junior CEO about that. About if he thinks it's going to be harder to get permitted in the Yukon now, because now all of a sudden you're going to have a lot of NGOs that'll be able to raise money on the back of this, and also a lot of the indigenous communities up there are going to be against it. So it's going to be interesting to watch. In his opinion, he thinks it's just going to take a lot longer to get permitted now. But
Yeah, and more expensive too. Years longer and more expensive. I think we're seeing a similar theme now in a lot of Latin American countries too, whether it's Mexico or Panama, Chile, Peru. A lot of open pit copper and gold mines. They're just looked at as eyesores. So if they're anywhere near like a large amount of population because of the chemicals used, people just don't want any of these open pit copper and gold heap leaching operations near water or food supply.
yeah, that's true.
So then this sounds like there's going to be a lot less supply if the permitting is going to be delayed 5 years, 10 years, maybe even longer than that. It just seems like there's going to be less supply of these giant copper mines with gold and silver byproduct.
Yeah, it's hard to say. I mean, you've also got other jurisdictions where there's potential copper deposits that are a little more friendly towards the mining industry. So I mean, look at Ecuador as a good example.
Okay, so you think then that Ecuador is going to be a copper and gold mining powerhouse going forward, not
I
just
I
like,
mean, I don't know. I don't want to make that prediction, but I mean, the Adventus mine got permitted. So, and there's been some other mine projects down there that have gotten permitted. On the other hand, look at what happened to First Quantum with their mine down in Panama. I mean, it's country specific. I would say that it's probably going to be, not that it's ever been easy, but it's probably going to be a little more difficult for like the big Arizona copper projects to get permitted, and it's going to take a long time.
wait, you mean in the United States?
Yeah,
Or, okay, because there's
the
like
United
also,
States isn't necessarily as mining friendly as the perception is, because in most of the states, it's not that easy to get permitted.
yeah, I agree, especially with like the environmentalist lawyers at the federal level. So it's not even at the state level, it's like at the federal level with the Environmental Protection Agency or the environmentalist lawyers and NGOs. So they fight stuff like the Pebble Project in Alaska. I remember the narrative used to be that Alaska has never blocked a mine until the Pebble Project, and that's been delayed like 15 or 20 years already.
Yeah, I don't that's just a bad setting for a for a copper mine. I don't blame Alaska for blocking that.
Well, I think it's like the people, mostly people in DC and other groups, but it's got what, over 30 million ounces of gold there, reserves, and like an insane amount of copper. But I'm not
It does,
sure.
but you know what? There's a lot of people that make a lot of money off of the salmon fishing industry up there, and it's that mine is sitting right on top of a very fertile salmon fishing body of water. So
Oh, yeah. It's also very profitable to be an environmentalist lawyer or a lobbyist here for green energy here in the Washington, D.C. metro area for the energy spending growth. A lot of these people make way over way over six figures a year. A lot of them make way over $100,000 a year.
No, sure.
Last question here. I want to ask you about Silvercrest. So for our listeners out there, Dave, one of his best picks in his Junior Mike Stock newsletter was Silvercrest. He got in early. Do you expect mergers and acquisitions that Silvercrest is going to go buy another silver junior and build another silver mine in the next couple of years?
Well, and I can't remember the name of it, but they've got a silver project in Sonora that I think they're going to start. They may still be working on it. I mean, to be honest, I don't follow Silvercrest that closely anymore because I mean most of the juice has been squeezed out of that. And I first recommended it in early 2016 at 16 cents. And I mean, now you got to kind of treat it from an investing standpoint as, a company with high grade silver mine that it's got, upside leverage to the price of silver, but whereas they need to start developing other projects in order to generate, a growth multiple. So, and I know they have a project that they like that they've been drilling it, but again, I don't know the latest status of it. On the other hand, I mean, Eric Fear could do what he did with Silvercrest Mines. He could sell off the operating mine and spin off the project into a new company. That's how Silvercrest was formed, Silvercrest Metals.
Yeah, a lot of the silver miners with the earnings the last couple quarters, they have not been the free cash flow generating machines despite the rise in the silver price. I mean, one of the silver miners, I think it was Endeavor Silver, they had a hedge book in place. They had put a hedge book at the wrong time. So I think they have losses, even though there was a spike in the silver price. And so a lot of the costs, one of the major themes, Dave, I don't know if you've looked at the earnings for a lot of the gold and silver miners, but it seems the costs are still rising for a lot of these miners substantially, almost every quarter.
Well, I think that's because they're spending a lot on capex and on sustaining capex. I mean, the price of energy has stabilized at least for now, so that's helped. And again, it's just specific to each mining company, really, what their costs are. I mean, most of the gold miners that have been reporting have blown away estimates. Um, Silvercorp just beat and they're obviously more the silver with a little bit of gold. Their stock is up nicely in after hours. They reported after hours today.
I think labor costs are rising a lot, though, in a lot of these emerging market countries. So, labor costs, you see, there's tons of mining unions in a lot of these emerging market countries that are asking for higher wages. So, that seems to be a common theme, whether it's Chile or other countries.
Yeah, I mean that's just part of doing business. I mean, and especially when these companies as they start to make a lot more money, because you're sitting in a sweet spot here where you've got even though the all-in sustaining costs have gone up a lot over the last few years because of price inflation, you've got a really nice for well-run companies with lower all-in sustaining costs. You've got a nice spread between what you have to pay to get the metal out of the ground and what you're getting paid for it after you refine it.
And the government's also like at a certain point, if gold prices stay at these levels or go to 3,000, they're going to want to renegotiate the royalty taxes. So unfortunately, this is just the new normal. We saw the same thing with the copper price spike a couple of years ago in Chile, where the government wanted to renegotiate all the royalty taxes for the copper miners.
Yeah, we could see that again too. I mean, government's always got to get their quote unquote fair share of the pie.
Well, Latin America, Dave, it seems like the elections last, I don't know, 6 to 8 months. A lot of these countries like Colombia, Mexico, a lot of the people that are getting elected are either anti-mining or pro-environmentalists. And so, like, I think best case scenario, they're going to be causing much higher costs for the permitting for these open pit copper and gold mines, the heap leaching, or delaying them out years.
Again, it's specific to each country. I mean, if people look at South America or Central America and they're like, oh no, political risk on these mines. But if you study Nicaragua, for instance, that's an extremely mining friendly jurisdiction. And yeah, the government gets a piece of the pie, but they're not greedy. And and same thing down in South America. I mean, I've got a big position and a very, very strong recommendation on Cabral Gold, and they've got what could be and just prolific gold project down there. And they already have a trial mining permit, and they're going to start doing a startup mine that they're wrapping up their pre-feasibility study, and once that's out, they'll start working on getting the mine financed. And rather than going and acquiring an operating mine, they've got at surface, near surface, high grade ore. It's saprolite and mud, and it's very, very cheap to process. And they'll generate their own free cash flow to fund the advancement of the even larger resource that sits. Wouldn't necessarily be an underground mine, but sits at deeper levels. Open pit style mineralization that sits at deeper levels.
Which country is this Cabral Gold in?
It's in Brazil.
Okay, yeah, most of Brazil is fairly pro mining. I mean, they have Vale down there. So Vale is one of the mining giants for base metals. They have a lot of copper, iron ore, I think nickel, and now some gold deposits.
Right. Well, G Mining Ventures just started up their mine. It's a long name that starts with a T, but it's the abbreviation for it is the TZ mine, and the CEO of Cabral co-discovered that the deposit for that mine plus the deposit for Cabral's project, and it's already been shown to be higher grade than the TZ mine, and he thinks that just based on what he's seen so far, he thinks it's going to be a much larger resource than the TZ mine.
Yeah, also with Malay in power now, it looks like Argentina is going to be more mining friendly too. It was already headed in the right direction for most of the provinces, except for the one where La Navidad is, because Pan American Silver has been, as you pointed out in past interviews, they've kept the world's largest, or arguably the world's largest, silver mine on care and maintenance for many years.
Well, that's because there's a regulation there, a law against using cyanide, and that's province specific. And I think Pan American thought they could get that changed, and it doesn't look like they're going to be able to.
Well, Rick Rule has talked about that in interviews for my listeners who want to go back and listen to archives. Rick goes down to like Paraguay and Uruguay for vacations, and he speaks with the higher ups, with Doug Casey in those countries. So he basically said that like to get the permit switched, there has to be a certain amount of money that changes hands. The family that rules that province, and Pan American Silver has not wanted to pay the tax to the family that runs that province.
I don't know. We'll see. All I know is I did really well with Aqualine Resources, which was the junior that was advancing that project when Pan American took them over.
Well, on paper, isn't it? It's 400 grams per ton silver. It's open pit mining, and it's got 500 million plus ounces of resource or reserves. It's a really large
Well, it's
silver.
got 700 million ounces of resource.
Wow.
Yeah,
And they've hardly drilled it, so there could be even more than that, I think.
I don't know. I mean, I basically stopped following it. I've never been a fan of Pan American Silver, and I basically stopped following that situation other than, when I see news release updates on it. So I like you said, it's been on care and maintenance since like 2013.
That's insane. 700 million ounces of silver at that high grade, and it's not going to be developed. I'm just shaking my head. But this is, unfortunately, you hear stories like this all the time in mining, or you see stuff that happens with Victoria Gold or SSR mining, like a problem child where an open pit mine, you think it was in a safe jurisdiction, and then something goes bad.
Well, you know what? There's an adage in the industry, not every good deposit gets converted into a mine.
It's very true.
A lot of risks that go into the mining business. It's a tough business.
Yep. Even Franco-Nevada got hit bad on the Cobre Panama deal. I think the shares dropped from $140 to $160 down to $110 for many, many months. So even they were considered bulletproof for years.
I know.
I want to thank you.
I remember when that happened, I was waiting for the stock to go just a little bit lower, and I was going to load up on it, and then it started taking off again. So
it was stuck around 110. I mean, I saw a lot of people saying they wanted it below 100 before they bought, but I mean, like these businesses don't stay too cheap for that. Royal Gold had a deal restructured many years ago, and it dropped like 50%. And there was like a 6 month buying window to buy the shares while they restructured the Mount Milligan gold stream. You can see it on the max chart if you look at Royal Gold. So there was like a 6 month window to buy it at a 50% discount. And I don't know anyone who bought it. Like no one would buy it. Everyone was like, oh, well, I'm going to buy it if it goes lower. And no one actually bought it.
Yeah, I was one of those ones waiting to see if FNV would drop below 100, and it didn't. And so, my loss.
Yeah, well, that's why you don't buy all your position at once. I mean, like I was writing articles on it at 110 back in like November, December for my patrons that you could start adding at 110. I mean, it's corrected a little bit recently, but they have done some smart deals, I think, long term. They've been adding like some smart royalties with some juniors that have some mines that could potentially go into production in the near future.
Yeah, I don't really follow Royal Gold. It's too big for me. I like the small, riskier plays. Although I do cover a lot more mid cap producers.
Do you think I knew you were covering Fortuna Gold and Silver. Are they in a sweet spot right now still, or do you think there's problems?
They're totally in a sweet spot, man. That company, their Segala mine property alone is worth the entire market cap of the company. Yeah, no, and they've got a new they acquired a company in Senegal, and they've got a high grade gold project there that they're rapidly advancing, and they think there's potential for a world class deposit on that property, and we're talking like 3 to 4 ounces, 3 to 4 grams per ton of open pit resource. And West Africa, unbeknownst to a lot of people, is one of the most mining friendly jurisdictions in the world, and it's probably easier to get permitted there than just about anywhere in the world. I mean, they got there from the time they took over Roxgold. They got that Segala mine constructed in, I want to say, less than 18 months, and now that thing is just, I mean, it's a money printing machine.
Yeah, I have some other friends like Peter Spina, Goldseek, who he's a big fan of Fortuna Gold and Silver. He thinks that they're the top mid-tier gold and silver producer right now.
Yeah, I agree with him. I chat with him almost every day on WhatsApp, and I actually think people should be taking a closer look at Caliber mining. I mean, they're the ones, they're going to have the Valentine mine in Newfoundland. I think they're on target for the first pour either in the first quarter or the second quarter of 2025. They're going to be producing a lot of gold. I think not including the potential increase in production at their Nicaraguan gold mine complex. I think they're going to be producing in excess of 500,000 ounces a year once Valentine is fully ramped up.
Dave, I want to thank you so much for your time today. You've actually given my listeners a lot of interesting stock picks there for free, but they should definitely check out more of your insights in your newsletters.
Yeah, they can go to investmentresearchdynamics.com, and there's a link on the top of the website that'll give them all the information they need to know. At some point, I'm going to raise the subscription price because it's very inexpensive.